Royal Bank and TD kicking off earnings season for the big Canadian lenders today. Royal Bank beating expectations. Its provision for credit losses lower than expected, but the bank does plan further job cuts as expenses climb. Meanwhile, TD missed expectations. It actually had an increase in the provision for credit losses. Let's get more on these results. We're joined by Paul Harris, partner and portfolio manager at Harris Douglas Asset Management. Paul, thanks very much for joining us.
My pleasure, Andy.
You haven't had that much time, I know, to go through these earnings, but Royal Bank, anything jumping out for you here?
I think the big thing is, and you had a lot of people on the show over the past week talking about, what's going to happen with bank earnings. And I think the reality is that's what's happened is most of them have had higher expenses. And I think that although Royal, didn't increase loan losses as much as TD had to, I think those are going to be par for the course over the next little while. So I think it's a difficult macro environment for these companies, and I think that that's reflected in what's happening not only in their earnings but in their stock performance over the last little while. But I think it really comes down to, one, those things are backward looking. Who knows what's going to look like in the next 6 to 12 months. But I think you have to look at these things and say, are these good businesses in this country? And that's yes. And are they trading at extreme valuations? And that's not the case, right? I mean, I think of all 6 banks, the yield is about 4.9%. The PE is about 10.5, and the price to book is 1.2. So they're not trading at extreme valuations. So are you, should we be looking at buying them at these levels? Mm-hmm. Probably, right? So I think that's the big issue with these things. I mean, yes, it's going to be a difficult macro environment for the next, 3 to 6 months. I don't know nobody knows what's really going to happen with interest rates. The chances are they're going to stay high, and they're going to stay high for a little while. Mm-hmm. But I think that's what you have to look at. And the other thing with these institutions, these banks, they're much more diversified than they ever have been, say, in the 1990s. Even like TD Bank was basically an Ontario bank in the 1990s, right? So they're much more diversified in their revenue streams, and so they can manage through this, and they've got lots of capital. CIBC is probably at the edge of that number of their capital requirements, but the vast majority of them have strong capital. So it's not a bad environment for them, and they can manage through a difficult, I think, macro environment.
One shoe out there we're looking at, CIBC down almost 20% in the past year. Just looking at Royal Bank, now I know we get into world of accounting here, but there was a decline in provisions on performing loans, but higher provisions for impaired, and apparently there was a jump within questionable loans in real estate, commercial real estate. So that is a cloud over the whole banking sector.
Yes, I think that's absolutely right. I think commercial real estate is going to have a difficult environment over the next little while. I mean, that's kind of happening in North America and maybe globally, but certainly in North America, you've seen that, and you've seen companies like Brookfield Asset Management or Brookfield Corp have a difficult time and trade at a big discount because of their big real estate holdings. So I think commercial real estate, we have to, I think that's one of the big issues looking forward is what is going to happen to commercial real estate, or and how these people are invested in it. I mean, that's a big question mark, and I think that's really banks are going to have to deal with that issue over the next little while. So there may be some further impaired loans because of that. Mm-hmm. But I think they're actively understanding that that's an issue and preparing for that, as opposed to sort of being blindsided by it, right? So there's a big difference when you understand the issue and you prepare for it, as opposed to saying, oh my gosh, commercial real estate, I've got a big loss, right? That's not happening. So I think that's the difference between probably now and many, many years ago with banking. They have this perspective of their businesses. They understand them a lot better because they have more data, and they can prepare their balance sheet for that.
Could we turn to TD? They had a headline miss. Now, according to Barclays, a lot of that can be attributed to the U.S. retail segment, where margins fell and provisions increased. John Aiken of Barclays is saying, we don't anticipate an overly negative reaction, but we think TD will underperform Royal Bank stock today.
Yeah, I mean, so a couple of things. I mean, TD is certainly the best capitalized bank of all the Canadian banks because their deal at First Horizon didn't go through, which is probably a smart thing. On the retail side in the United States, it's a much more difficult environment because people have a lot more options on the retail side. They could take their money and move it to other institutions a lot easier than they can in this country. So I think that is a very big difference, and also a lot of money is being moved onto the money market side. So I think that hurts retail banking in the United States a lot more, and that's TD's got a big U.S. franchise. Saying all that, I mean, they have an opportunity maybe down the road, like they're buying back their shares. So that's one thing. Then number two, they certainly have the ability to buy other assets because of their capital base, which allows them to maybe grow their business a lot more than other Canadian banks and maybe be a little bit more aggressive on the purchase side, given the valuations of some of these regional banks in the United States.
Yeah, it is interesting. TD has that strength, doesn't it? The huge amount of capital on its balance sheet gives it flexibility.
Yes. And I think that's really important. I mean, especially if you believe that we're going to a difficult macro environment, having a good balance sheet, having lots of capital makes a big difference and allows you to be opportunistic at the right time, whether it's in Canada or the United States.
You know, it's interesting. TD, it got some unpleasant headlines after it had to walk away from the First Horizon deal. Apparently, U.S. regulators had misgivings. But over the past 5 years, TD has pretty well matched the banking index, a total return of 31% over 5 years. So the stock hasn't been that bad.
Yeah, I mean, I think the funny part about this thing is these are great businesses in this country, right? They're highly regulated, which is way better than the United States. They have scale. It's an oligopoly or whatever you want to call it in this country. So, they have better pricing power. They have lots of wonderful things that make a good business. And I think that at these levels, you're not paying a lot for them. So, I mean, it behooves me to understand why somebody would say, sell them or something like that. You have to own them here, not sell them here. You own them here because over the next couple of years, they're probably going to generate great returns, right? Especially if the interest rate market changes, which is maybe a big if, short term, 6 months or so. But longer term, interest rates probably come down. And so these businesses will do very well in that period of time. And they can take advantage of the fact that, it's a difficult time like Royal is and cutting their staff. They probably overstaffed over the last little while. So bringing down their staff. And it's a difficult thing for banks to cut staff in this country, right? They're seen as pariahs. And so cutting staff has to be done very quietly.
Thanks.